And ladies and gentlemen, welcome to another episode of the TradingView live show where we talk with traders and we talk to market experts and anyone interested in charts or furthering market education. And today we have a very special guest because this show is sponsored by TradeStation. TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self directed traders and investors across the equities, equity index options, futures, futures options, and cryptocurrencies markets. And today, someone from TradeStation is joining us, and his name is David Russell. And David has a very important job at TradeStation, looking over global strategy and global markets. And I'll let him take the microphone from here to quickly introduce himself. And one thing that's really great is David has got tons of charts to show everyone watching. Some might say these are the charts that traders and investors should be watching at this very moment. The chart on the screen right now we'll get to. But David, quickly take it away and introduce yourself to everyone.
Well, thanks a lot, Steph. So I'm the VP. I'm sorry, I'm the global head of market strategy here at TradeStation, and I do the trading ideas that you see on TradingView. I do the blog for TradeStation. I do a lot of client events. So my job is really to focus on where the market is now, where sentiment is, where things are going, and to have a sense of where our clients are going to be focusing in their kind of trading activity, which is exciting because I get to, do what I love all the time and look at charts like Steph said, and it's great to be with you.
Awesome, and I have to say one thing I have to give you a lot of kudos for is the TradeStation account on TradingView. The content that's coming through that account. Oftentimes, it makes it to editors' picks. There's some really crisp and easy to understand charts there. I think that account is simply awesome, and so I think it's cool that people who are watching this know that you're the author of those ideas and that research. So even before we get into the charts, curious to know how you come up with your research because there's so many markets now. How do you find a way to see what's interesting and then to synthesize that into an idea on TradingView from the TradeStation account?
So when we have clear sort of trends, I often look for things that are simply counter trend moves, like things that have been moving in a certain direction over the longer term and have a pullback of 1 to 2 weeks. Look for things that have pulled back to moving averages, or things that might have an oversold indicator in the short term when I have like a kind of clear trend following. But my real focus is often going to be at the macro level in terms of sectors. My biggest interest is really which sectors are doing well. What's the big macro story now? As we know, last year was about energy and oil. This year's been about AI. And so when these things happen, it goes beyond just the charts and the technicals of any individual stock. I try and look at what that big sort of theme is that's operating across multiple stocks across the market. And then I look for opportunities within that, whether it's bullish or bearish. But I look to kind of start with the big picture and then look down for opportunities within that big picture.
Fantastic, fantastic. And for all the new traders and investors who are coming into the show or come across it in the coming days and weeks and months, I think that this is an opportunity to learn more about that process because idea generation is not easy in markets. There's a lot to look at. There's historical information, there's technical indicators, fundamentals, and if you're watching, sit back and relax because David is about to show us a series of charts starting with what looks like the 10-year Treasury note yield, TNX. Tell us what you're seeing here, and I'm just going to hand the mic to you because I love this chart. This chart is history. This is 40 plus years of history right here on a single chart.
Yeah, well, thank you. I mean, the thing is interest rates have been falling in the United States since the early 1980s, and in many ways, COVID marked the very farthest end of that move. And in terms of long-term yields, and that did a lot of things to help the stock market overall. And there's a lot of reasons for it when you look at it. But the thing is that there's a lot of evidence now that that trend, which has lasted for years, is finally over and it's reversing to a certain extent. So if you look at this is monthly bars on the TNX, which is the essentially the yield on the 10-year Treasury yield, which is the most important Treasury when it comes to overall interest rates. You have a downtrend here that really started like in the 80s, and now we have basically a break through it that occurred a little more than a year ago, and we spent kind of a year consolidating above that old trend line. And what's really interesting here is we saw this move higher last October when the market basically bottomed, and the market bottomed when it peaked. This moves in the opposite direction. So when interest rates are moving higher, that is typically bad for equities overall, especially with multiples and those sort of points that people make. And what we can really see here is there was a level from late 2018 when the Fed tried to raise interest rates before and the market freaked out and Jerome Powell backed off. This was the high back there in 18. And we see now is we very neatly kind of held it. So with yields moving higher here, I think right now this is the main thing we need to be aware of. It's not necessarily a trade, but this is a condition right now that is weighing on the market. And I think it has the risk for some, a continuation to kind of pushing higher here. At this point, when you look at, the economy is strong, the government is issuing a lot of debt, and the Fed doesn't really want to be, cutting interest rates soon. They've kind of made that pretty clear, especially with some of the data we've seen recently. So at this point, there's more of a risk here of people not buying bonds and of bonds just kind of getting sold, and that means the yields go higher, and that becomes an overall sort of risk to the market. So I think we need to be aware of this right now because even though I've been watching it, it hasn't gotten as much attention as I think it deserves, and I think that kind of makes it one of these things that can kind of sneak up on us if you're on the long side. So the next thing is talking about that. You want me to go to VIX now?
Well, actually, David, really quick, for
Right.
the new traders and the new investors, and actually, it's surprising. I think what you just said is spot on. A lot of people aren't talking about this, which I also find surprising. And my comment on that is essentially maybe you just quickly remind people why this is so important because it's a trade-off, right, between equities or
Yeah.
between yield and dividends. Because now you can collect what looks like 4.3% on a 10-year treasury. So just remind people why that's so important.
Well, right off the bat, if you have money that you're looking to get a return on, if you put that in, if you buy a 10-year treasury yield, you have zero risk. You're going to get 4.3% for the next 10 years. And that right there is a lot more attractive than where it was for most of the last decade when it was under 2%. So now you can get risk-free at a much higher return than you could before, which means that there's more incentive to not buy stocks, to put your money into bonds instead. But the other reason is because a lot of borrowing is pegged to this. Mortgage rates are the most obvious, but corporate debt is as well. So if you're a company and you're going to borrow money over a 5 or 10-year period, if you borrow 10-year, you issue 10-year bonds, which companies do all the time, we don't talk about it, but companies borrow, they are going to pay a certain percent above the 10-year treasury yield. So what's going to happen is this raises the borrowing costs for all companies across the universe. So basically it means that it becomes a risk to their income statement or to their profits. And I don't have the chart on it now, but if you look at what's happened recently with the airlines or the cruise ships, these companies have a lot of debt. And as interest rates have moved higher, they've started to really suffer recently. And they had big rallies a few months ago because rates had come down. And now we see just the opposite. So the other thing is when yields are higher, there's a relationship where people want to see, the multiples should be lower according to this, theory that exists, that multiples should be lower when yields are higher. And so therefore, higher yields mean that people are willing to pay less for, equities, which means price earnings yields are lower in theory. And that in turn means that, people are going to say, instead of paying 30 times for Apple, I'm going to pay 25 times for something. And then that in and of itself, regardless of how well a company does, it has a negative impact on the price.
And before we go on to the VIX, I want to say something related to what you said about mortgage prices. I am searching for homes at the moment, new father, family of 3. And I must say, it's pretty fascinating, though, that I'm on pace if I were to buy a home at this moment, and I am looking, kind of have to, but I would almost pay more in my interest expense over 30 years than the sheer principal that I would put into the home. It's pretty jaw-dropping for a home buyer. So anyways, now we know why this chart is so important, and I hope that people have just learned something new because it's kind of an invaluable lesson. And let's go on to the VIX. I'm ready.
Great. So I would just mention very quickly, I consider this intermarket analysis. It's when you look at a different index to determine the S&P. So I look at things like interest rates, the VIX, and some of the other things like the currencies that help tell us what to think about the S&P. So this is something that's kind of a negative signal on the S&P. Another negative signal on the S&P is the VIX, the volatility index. which measures the cost of options near the money on the S&P future on the S&P index, which essentially when it goes higher, it means that people are more bearish. Typically, there's a few times when it might go higher in a bullish scenario, but for the most part, when the market falls faster than it goes up. So when it falls, then you're going to see volatility go up. So you know this is something that I don't always chart, but I think there's times when it makes these turns that are worth paying attention to. So it's interesting if you look back, and I'm looking at the daily chart. For a long time, really quickly, if you look back before COVID, it was down under 10. But then this is the COVID spike, and then if you look after COVID, it basically went down to about 15, and that was when we had the big bull run in 2021 before the bear market of last year. It never really closed under 15. So now, if you look at it this year, it's kind of coming down. This is last summer when the market crashed. You can see the VIX spiked higher. And then we can also see when Silicon Valley Bank happened, both of those times the VIX spiked higher. But you see here, after the debt ceiling was raised at the beginning of June, it went under 15 and it stayed there for 2 months. And then it jumped back over. And so to me, this is kind of a sign that, people are now more in that sense of being more fearful. So when you get a spike in it, it's not in and of itself the most powerful signal, but it helps to confirm that we're in a spot now where people are more likely to get kind of fearful. Also, to me, this is just a simple crossover. There's different moving averages you can use. In this case, I'm using the 21-day exponential with the 50-day simple. You can use different ones that are similar to this. It's kind of an intermediate, a kind of shorter term and a longer term. The key thing is that when it crosses, it tends to mean that you have little spikes like these, but then when you have it kind of move higher like this and you get the cross, it kind of confirms that this is not just a little spike in volatility or a little pullback in the market, that there's something a little more substantive happening. And so you can see when we've gotten those crossovers, it was kind of saw more continuation to the downside in the overall market. And we've seen it again here. So to me, these are just signs, again, to kind of confirm a bearish sort of sense. And, in the market, you look at things, the idea of confirmation. The classic example is Dow theory, when Charles Dow would talk about using transports to confirm something. But in many cases, this can be a good case of that. But I mean, transports have not been as meaningful as they used to be. But the thing here is that you use one chart to confirm another. So it kind of says, oh, the S&P is going down, and there's a reason why it's going down, because Treasury yields are moving higher, for example. So in this case, these other charts help to kind of inform the other chart I want to turn to now.
Really,
Before we do that, go ahead.
yeah, really quick, what I want to comment on this chart that's so actually cool is, and for those who are watching, David and I spoke yesterday to catch up. I wanted to hear what he was going to showcase. And we looked at this chart, and it's amazing to see that giant green candle there today. It's almost like I wish we did the show yesterday, because one of the comments we had was, wow, the market seems very complacent considering where the VIX was back during the Silicon Valley bank crisis compared to today. Does it really feel that much calmer? And it's interesting that we had that exact conversation yesterday, and now look at that green candle. Looks like the VIX is trying to I would say break out, but it's showcasing some potential there. So great chart, and I like the crossover. We can move on. I just wanted to add that
Yeah.
context because I love that we just spoke about this yesterday, and now it's popping as we speak.
I would just quote Jesse Livermore, and I don't know which rule. He has like something like 7 rules or 11 rules or something, and I try to remember them. But one of them is the idea that it takes time for moves to develop. And one of the things I believe is that you often see is that, you kind of have a trend and then it accelerates. And so the thing is, if we have something of a bearish trend that's developed in the last 2 to 3 weeks, it takes time to accelerate. And it seems to be what we're seeing right now as we speak on Thursday afternoon. We're starting to see the selling accelerate a little bit, and that's what we're also seeing in the VIX. So now I can go to the S&P. We haven't looked at it yet, so I'm going to now just do the S&P and go to a daily chart. I'm going to zoom in on some of these things, and I want to kind of show you guys some stuff that to me was interesting. So first I added some lines to this when we last spoke, but basically when the market has rallied, often one of the continuation patterns is just rally, retrace half the move, and continue. And very often when you look at things pulling back, you're like, why did it stop there? and then you draw the Fibonacci with the 50%, and that's exactly where it was. So if you look at the rally, kind of, and for Fibonacci, you often kind of want to start on a Friday, going to the extent of the move. Not always, but it's often kind of the way. That's what I did here. It was Friday the 17th of March, and then this was an AI started, and the Nasdaq started rallying even when the people were still worried about the banking crisis and all this stuff, and the Nasdaq took off and it dragged the S&P higher. We had that rally. We held 50% of the move. Then we had this breakout over the February high, and then we retraced 50% of the move and held. There was another little move here where we kind of where we came off that low. It was right here to here. It's hard to see all these, but it went from here. This was basically the low of June 26th up to the high of July 3rd. Then we came back and we held it on July 6th and 7th, 50% we held. So I put the holds in green. And then we had this move basically off the, from the end of July up through this period here. I'm sorry, the end of late June through late July. This was the 50% level right here, right around 44.80. And we tried to hold it and we didn't. So to me, this kind of confirms, like, this confirms uptrend, this confirms uptrend. Each time it holds at 50%, it confirms that we're in an uptrend. Then we fail to hold it. Now we have non-confirmation of an uptrend. So to me, that was a big thing that we saw here. And you can see that now the move is accelerated as, like Jesse Livermore says, it takes time for moves to develop. You see some signals, but and then you got to be careful not getting too antsy and wanting to get ahead of it. But you'll see it start to accelerate. You have this kind of uptrend. You're not going to go from a monster uptrend to a violent sell-off quickly. It needs time to transition from one to the other. And that's what we kind of saw happening in the last couple of weeks here.
I want to say to your use of Fibonacci here, I love it, I must say, because I've seen some very complicated usage of Fibonacci, and I think the simplicity of this is just awesome. It's you've distilled it down to three important aspects of Fibonacci with that 50% retracement. So you just see the top of the Fibonacci, the bottom line of the Fibonacci, and then the 50% retracement. And for those who are interested in trend following, I mean, this is to me like a textbook way to try to find a trend. So this is a really cool, and it is interesting to see it trying to hold. It bounces right at that 50% retracement at the fourth time and then it's interesting when it breaks fast. I mean, those are three pretty enormous red candles, just following each other the last three trading sessions. So super interesting. And I'm guessing this also ties back to rates, right? Because rates are breaking out, thus making equities less attractive. So it's all happening at once. Is that kind of how we should be thinking about this?
Yeah, I think that this bull market took people by surprise for various reasons. There was massive negativity. And then as it happened, people got, everyone started getting bullish, and like the last of the negative people started raising their price targets, and we got to a certain amount of kind of complacency, I think, here. And then people suddenly look and they realize, wait a second, earnings season is over, interest rates are moving higher, and we're entering a period of the year which has a history of volatility. There's not a lot of volume, in this series. Was you going to late August toward, Labor Day and the holiday season. So there you already have people saying, you know what, I'm going to kind of, walk away. And then what happens is it's kind of like a party. People start leaving, and there's one or few people, and then before you know it, everyone's gone. And I think that's kind of the way to think about something like this, is that there's people who are like, oh, I'll wait. I'll wait. I'll let it hold, 44.80. I'll kind of see what happens. But not really working anymore. And then the orders start trickling in, stop losses start getting hit. And then that's when the acceleration happens that we're seeing now.
I like the party example. That really does simplify it. And what's the line? Don't be the last one to leave, right? In the markets, you don't want to be the last one to leave. You definitely don't. Okay, I don't want to prevent you from showing us some of these charts and showing people some of the things that stand out in markets right now. So what do you have for us next?
I did want to just mention, I added this one, but the August of this high from last summer, right around 43.28. This was near our low at the late June. So this level here is the one that I kind of have on my radar as first support. And then depending on how difficult things get, something down even toward 4,200. I mean, to me, that would require something pretty dramatic. And but I just like to draw the lines and kind of and think, you know, it's important, I think, to draw lines because the thing is, you know, when things start happening, it's easy to get emotional. And if you have those lines drawn, and sometimes I've drawn a line and then like a month later, I suddenly am like, oh man, what's going on? And the market's going crazy. And I look and there's that line that I'm like, God, thank God I drew that line because now I know it's there and it helps you and it helps overcome some of the emotion that you can get when you have intense volatility. So drawing those lines and keeping them. I have different charts on TradingView, and there's some I just kind of draw lines on, and I don't do anything else with. I draw like my support lines, and then I don't touch them. I just and then suddenly one day, boom, something gets hit. So
I
wanted to
want to I
mention
want to say
that.
on that note, when you zoom down on the chart a little, yeah, zoom out once again for that August 2022 high. So I could not agree more with what you just said about lines because when you zoom out like that and show that next level, it feels like, oh, there's a roadmap ahead. You know, don't rush into a trade or don't do anything too impulsive because actually, if you do draw a line on the chart, you can sit back and wait a little more patiently. You know, it's really nice to see that because even just my right when you zoomed out, even get a little more clarity on maybe what to wait for next in the S&P 500. So
And
that's a
it also
beauty.
helped. And it also you had a really nice confluence with that 50% retracement. So you had a double sort of confirmation that that was a pullback to buy. And one thing I'll mention about levels, if you go back here, we had a really strong reversal back here in late April of 2021. And that in many ways between the high of March and this reversal about 4 weeks later, you know, this is not surprisingly where we ended up kind of peaking recently. So I think that's kind of interesting. Also, if you look how we bounced at this level here, it became the bottom of this bearish outside day, and then it became the high on these following sessions. These candles, you can see this level here was 45.28. So having those levels, and then if you just do something like go to the hourly, and then you're, you know, if you're in a day like this and the market rallies, you suddenly realize if you were back here on August 4th, you're like, wait a second, I've seen this level before. I saw it back on July 21st, and now you see, wow, you know, support's becoming resistance. It kind of helps to tell you, you know what, maybe this move is kind of going the other way. So I agree. It's good to have those levels. So
Fantastic walkthrough right there. There's a lot of people who are going to benefit from watching that. Let's see the next chart.
all right, this is gold XAU USD. Now I'm going to go here to a weekly of this.
Oh yeah, we had a
So
great chat about this chart. I'm excited. Let's dive in.
well, back when COVID happened, we had this real monster rally in gold and especially in silver. And we had a trading view idea at the time. I remember it was called Golden Cross and Silver, and it was this big move in like the summer of 2020. But then basically the Fed was throwing money at everything, and that, you know, that pumped up gold. But if you see, gold got above 2,000 a few times, really since summer. You know, that was now, God, 3 years ago. Hard to believe, but it hasn't been able to get above 2000. And what's interesting here is on the weekly, you can see in the mid July, it made a high, this lower high under 2000, which to me is pretty concerning if you want to be a bull. So what's also interesting here about this is this confirms something. And like oh, actually, I was going to go to euro, but this is good because the thing is, like I said, you know, I like to think about um, you know, one chart is being related to another. In many ways, gold is going to move in the same direction as the euro. It's going to move in the opposite direction of interest rates, the opposite direction of the dollar. So when we see something like gold moving down like this, it absolutely confirms and corresponds to interest rates, the TNX moving up. And it corresponds also to things like, you know, the strong dollar that I'm going to show you next. So to me, this is something that it kind of tells you that, you know what, this idea of the dollar going lower, invalidated, not real. When you see gold fail to get over 2000, it basically tells you gold, it tells you that there is really not that much upside in the euro, and it tells you the dollar is on stronger footing than you would think. So that's how what I took away from that.
You know what I find so fascinating about this chart, you know, beyond what you just said, is how gold has hit all-time highs 3 different times in the last 3 or so years, but over that time frame really hasn't gone anywhere. And I find
Yeah.
that so interesting, especially the triple top there that you have marked. I don't know about you, but I've never seen a triple top that perfect over that long of a time frame. Like if there was an art gallery for great setups in technical analysis, I would take a picture of this and hang this because that is really something else to me to like be seeing a triple top that perfect. Curious what you think about that beyond the intermarket analysis between the 10-year and the euro and the dollar. Um, do commodities tend to really respect technical levels from your point of view, or do you have any opinion on that? Because this triple top is so perfect, I imagine commodity traders must be, they must respect technical analysis to some aspect to see this.
Well, my perspective, this gives a pretty strong, bearish signal to gold. It does have that sort of technical importance here, and my perspective is that in many ways, though, this in the long run, it confirms that we're still in a bull market for equities.
Mm.
If you look at, gold has good runs in bear markets like the 1970s and the period of the first decade of this century. So what's interesting to me is to see here that gold has not been able to break out. It tells you, first of all, that the market knows long-term rates are going higher. So this anticipated that increase in yields that we started with, and it also basically shows that people still long term now see opportunities in equities, and I think that's ultimately something that's going to be good for the Nasdaq over time because these things tend to not they tend to not move together. They tend to move opposite each other. So seeing strength in gold is actually, I think, a long-term bullish for technology stocks in the Nasdaq.
Interesting. And the thinking there, the research you might see, or the studies, or the data behind those correlations is because gold has sort of a safe haven, mindset to it or brand to it. If it's trending downward, then it might demonstrate that actually some investors are seeking more risk. They don't feel the need to be in a safe haven like gold. Is that sort of the thought process or the
Correct.
trade off? Yep, got it.
Yeah, and gold doesn't produce any growth. Companies like
Mm.
Apple and Microsoft, they grow earnings over time. Gold doesn't do that. So if you want something that doesn't grow, it basically tells people that you don't believe growth is going to happen. And there are times when it doesn't happen. So I think that in many ways this shows that long term there's still an underlying bull market happening here in equities because gold, when you consider how low interest rates went until a year or two ago, gold should have gone higher. I mean, this is a pretty bad sort of pattern here for gold. Now, I want to really quickly also mention like the gold miners, NEM, for example. This is Newmont, which is a big gold miner. This stock basically hit this high way back when the Ukraine war started, and it's been bearish ever since. Gold miners have really done much worse in physical gold, and that's been another sign that gold is long term people are not seeing opportunity in it. So I wanted to point that out because you can also look sometimes at like oil drillers will often lead the price of energy, and the same thing can happen with something like a producer like the gold miner. So this also confirms the downward sort of trajectory in precious metals.
Very interesting to, especially for those who are trading gold or looking at gold or investing in gold, to look at the gold miners as well for some more insight. I think that's a very interesting sort of research process, something that I have not considered, but I can see why it makes sense because the gold miners, after all, are the ones who are digging up the gold. So you probably want to check in on how they're doing.
Yes.
What charts do you have
And
for us next?
okay, so the euro, I'm gonna do a weekly chart of this. And so basically, I actually added a Fibonacci to that I'll mention. But so the euro here has this channel, and we actually did an idea of TradingView on this when it was coming off the bottom of this channel. But this is kind of what I'm pointing at here is that in many ways, we saw this kind of rally since late last year in the euro, and it has simply been in a channel since. And what I just see here is the potential for it to go down and test the bottom of that channel. And that again is, kind of bearish for stocks. Companies, usually a strong dollar. When this goes down, the dollar index goes up. So usually, something like this would be a negative for equities. This also moves in the opposite direction of American interest rates. So when interest rates go higher, the dollar goes higher and the euro moves lower against it. So this is very much consistent with what we showed before. And it shows that the euro has weakened, but it could have more downside. And if you look at it over the longer term, if you look at this drop, from where it was the beginning of 2021 through here, it's right around half of that move. And this could turn into a longer term bearish flag with, that 50% retracement. And so from my perspective here, I think we have to kind of be on guard. When you look at what's happening with the Chinese economy, which hits Australia, when you look at, Europe in general, German industrial production has really fallen. To me, the euro here is an interesting spot. When you look at where gold is going and interest rates, there could be more sort of risk here in the euro. And I think at least down to the bottom of this channel, which has kind of moved since we spoke yesterday. I'm trying to see, when we talked yesterday, it was higher up here, but wow, it's interesting just to see this here.
Yeah.
I mean, to me,
that channel's acting like a magnet. I mean, that bottom of that channel looks like it wants to act as a magnet. Like it's just pulling price toward it. I'll say I love that intermarket analysis too, where you can sort of see the medium term trend for the euro, and then you have that longer term time frame Fibonacci, which I think is really cool for, I keep saying for new traders and investors, but I know there's many joining the stream. It's, you can sort of map out the intermediate term TA, but still have perspective on the really long term with that long term Fibonacci that you drew as well.
I mean, in many ways, the market is like a broad sample set across many things. If you have a theme like strong dollar, it's I don't know. It's kind of like if you sample any group of things, you start to see patterns developing. And if you have a bunch of animals and two of them start getting sick, and the next day 3 of them start getting sick, you think, oh, there's something happening here. They don't all just get sick at once. So the thing is that you start to see, like, you have gold, you have interest rates. All these are like different kind of animals that are going to start giving at different times, showing symptoms of a bigger trend happening. And so I really try and focus on those bigger trends. And in many ways, higher interest rates, it's weaker gold, weaker euro, all of those things. And if we look back, look at this rally that we had here. It started in October. Now look at gold. Gold, exactly the same.
Wow.
Right. This is now the daily of gold. I showed the weekly before. So I mean, these things are correlated assets, and I think but one moves a little bit more than the other, and it's not always clear which one moves first. But what matters is they move together. So when one is giving a signal, that can really increase your odds of being right and positioning correctly when you look for the correlated asset to follow.
And I'll say to that point too, which I think is great, is there's an element of a top-down approach, which I think is actually maybe not a discipline that gets enough attention, where you are starting from what's the biggest, most important, or maybe largest component of this macroeconomic picture, interest rates. And now you're kind of taking us on a journey as we keep going down, 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 down. We're zooming in a little bit more the further we go. So it's pretty cool. And what comes after Euro USD? You have some more charts, right? Or should we keep diving in from?
No, I do. Yeah. So basically, I want now to go kind of looking at some stocks and sectors that I see some interesting patterns with. Now, I am looking at, I do a lot of stuff when I actually look at the sectors, like healthcare, technology, communications. These are the main sectors the market is broken up into. And they tend to often, stocks often will follow their sectors. So Apple goes down, technology goes down, Microsoft is tech, and they move together. So right now we're going to look at, this is one that's a little bit on top. No one's going to necessarily trade this, but this is healthcare versus the S&P 500. So what's interesting to me is if you look, last year, when the market was bearish, this thing rallied against the S&P. And there was a time when healthcare was like one of the few sectors that was doing well. And then when everyone went to tech and the market rallied, now this is a ratio. This is not healthcare itself. This is the ratio of the S&P against the market, healthcare against the S&P. You can see when the market is, you know, when people are more bullish, they don't like healthcare, and when they're more concerned, they do like healthcare. It's interesting just to see here that this is near the bottom of a longer term range. This doesn't have the full history, but if there's other charts I've seen, that show this is actually historically, healthcare is now at a spot that is very historically low relative to the overall market. And I think that this might be something, if we're in a period now of people being scared about interest rates or scared about the economy or whatever, healthcare has that sort of appeal as a counter trend sector. So I wanted to mention that because it worked. It was an interesting one last year when the market was in a bear market.
And counter trend because healthcare is so ingrained in everyday life that it's really hard for it to go anywhere. Like there is always sort of payments coming through. So sort of is it sort of
Yeah,
a safe haven within the equity market? Is that the way to think about it, or the way markets
yes,
think about it? Yeah.
absolutely. And it is a safe haven. And there are other safe havens, and I'm going to get to some of those because they haven't been so safe recently. But the thing about healthcare, and I think is interesting about it, is it's actually still a growth area because of the aging population.
Hmm.
Healthcare remains an area that is going to be growing over time, unlike some other parts of the economy. So I think it's especially interesting to be aware of in this kind of environment. And it seems interesting to me that, and we also had some interesting earnings from some of these companies recently, like Eli Lilly. So I just want to point this out because healthcare right now, if we're in a period of time where people are kind of cautious and stuff, it has this kind of it has this established sort of counter trend behavior.
You know, I want to add to that quick because it's interesting. I have to fact check it, but the aging population aspect, right? That's also because the sheer number of people over a certain age in the U.S. is larger than, say, anyone aged 20 to 35, for example. So it's kind of an imbalanced demographic at the moment. And obviously, as people age, they need more health care. So that's an interesting comment, something we probably could do a whole podcast on, actually. Um, but you know what? Speaking of these ratio charts, one I do really want to see that I know you have, and I think you can share it. I'm not sure. Is the semiconductors?
Yeah.
That one is so cool to me because it kind of reminds me. Yeah, this chart. Tell us about this chart.
This is SOX, the Philadelphia Semiconductor Index, divided by SPX. And I will say one of the things I love about TradingView is you can just build this yourself. You just put in a formula, divide anything by anything else, and it'll show you. So basically, this is the ratio of the semiconductors against the S&P 500, and you can see it reached this real fever peak back in 2000 at the end of the dot-com bubble. And it's been a monster bull run since last 7-8 years, but now it's back to a point where it has pretty much reached that old high. So I think this is a thing now that kind of is a little bit of a warning that some of these big semiconductor areas might have reached a point of pretty significant valuation relative to the overall market. And unlike something like healthcare, which is kind of at the end of it's at the lower end of its long-term range, this is at the high end of its longer-term range. So for people looking at areas that are likely to kind of expand and have that real potential, there's reasons to think at this point that semiconductors have run their course for now.
I want to add that to me, this chart is the perfect example of why ratio charts are so cool because semiconductors, essentially, relative to the S&P 500, have only been up here one or two other times in the course of history. And one of those times is the dot-com bubble, which is, considered by some historians, market historians, one of the more euphoric times to ever happen in our modern market. So it's eye-opening, and it's a great way to measure risk in the sense of, you see all the hype around AI, very trendy right now. NVIDIA is being discussed all the time. But then you see this chart and you have to ask yourself, is this really the time to be getting on board with that trend? And that's why I love these ratio charts. And I think there's so much here to dive into because there's the AI component, there's the market history and .com component, and there's just great use of relative charts. And quick question for you about this chart for people who are interested in AI or semiconductors and what's happening in tech. How do you think they should think about this chart? Should it be something that they kind of maybe say, hey, this is a very interesting piece of research to maybe point out that the hype in the media might be a little exuberant, or how would you tell them to think about the chart, or to really do their research?
Well, it tells me that the industry is heavily owned, and you're at the party and everyone is there, and if people start leaving the party, where do you want to be in that line? And so, from my perspective here, and I do believe that markets go through long-term cycles of accumulation and distribution, and you know I'm not saying that I'm bearish in semiconductors, but I do think that you have to be more sensitive to heaviness in price in this, because that would actually tell you that some of the people are starting to leave the party, and it might be near the end. Now there are a lot of long-term arguments in favor of it. My perspective here would be that this is kind of telling us that this is now kind of fully valued,
Mm.
and they're not necessarily bearish per se. But the problem when everyone owns them is that they're not going to necessarily give you as much pop on good news, and they're going to be more vulnerable to bad news. And I would say we're not talking too much about fundamentals here, but the economic data in China continues to be very negative, and China is a big market for semiconductors, and I think that we should be aware of that, and I'd be very wary here of just assuming that the growth is going to that the next few quarters will be as good as the last 10.
Super interesting comments about China, and it's a nice reminder about how that type of news, if you can stay on it in your research process, can help you understand the action on the charts a little bit more. And I did read, for example, about China as well, that their car sales are really dipping, which is sometimes a barometer of how much money people have to spend, right? If you're buying new cars, you're clearly doing very well for yourself, but that prices for cars are dipping. So that is an interesting component that I probably haven't explored enough, but hopefully our listeners and viewers will definitely. Let me ask you this, David. I know we're approaching that hour marker on the show. Do you have a few more charts? And obviously, if we have to wrap up and hop off, that's fine. We can always do this again. But what other charts do you want to show us quick?
So I did want to mention here that the well, I'll just be really really simple about it. Procter and Gamble had a double top recently, and to me, what's interesting is unlike healthcare, the wait a second, this chart. Unlike healthcare, the consumer staples space is really not growing very well anymore. And I was looking at SIXR, which is the consumer staples. This is on a weekly chart here. This is the consumer staples index. Procter and Gamble is one of them, and we kind of see here that it had this triple top as well, and then it actually made a lower high. It's not that different than gold. Hey, both safe havens, right? So it's kind of interesting that they behave similarly. And so you have this lower high here, and now in my view, you could look for areas here down to there are areas here of space more to the downside. And so, from my view here, consumer staples are kind of in a pretty difficult spot right here. And Procter and Gamble is one that the last time I looked at it, it had a double top. And also, I had seen that the name like Pepsi and Coca Cola, both of them have been breaking out of kind of. I'm going to put my 200-day moving average back on. But all these moving averages close together essentially mean it hasn't done anything for the last year, which means that it can expand away from those. So from my view here, you have like a kind of little bearish triangle starting here on Coca-Cola. You can see where it kind of broke the bottom here as well, um, and you have the sector itself being bad. So I put those things together here, and I just kind of see this kind of popping up right now. We had talked about we had done this a chart view about the real estate investment trusts and how it had kind of broken down. We did this recently. This is the what's left over, and we had done the idea when it was pretty much right here, and this has now been just breaking lower. So this is, to me, this is not something people trade a lot, but it's incredibly bearish when you look at the long-term trend, and we look at this on like a weekly. So you can see that it had this is like a long-term bearish flag. So I want to kind of point this one out. All of these, again, they have a relationship to interest rates. These are income stocks, which means people buy them for dividends. They view them as safe havens. When Treasury yields go shooting higher, stocks that are valued on their dividends, like real estate investment trusts, consumer staples, and also utilities, all of those are at risk. And these income stocks, in my view, have been basically people have held them for years because interest rates were so low. And I think people now are just waking up to the fact that a 4.5 year, 10 year is not good news for REITs. And there's other stuff about REITs, but the interest rate risk alone, on top of that, it's not good news for utilities and consumer staples. So I'm kind of watching now as something we might see the potential. Some of these have some space to the downside, and that's actually what's kind of grabbing my attention now.
Wow. As we come to the end of the hour, I want to just reiterate something you said because you're waking me up to a lot of things that I'd even gotten complacent about, which is you're spot on. A company like Coca-Cola or Pepsi or Procter and Gamble that pays that maybe I'm just ballparking here 3% dividend yield or 4% dividend yield for the last 10 years was almost considered like one of the, people said that's one of the best gifts in the market to get a 3% yield or 4% yield. But now you can buy a treasury and get 4%. Like, wow, it really does do a lot of damage to that thesis. So, I mean, you could go down the list, and there's probably hundreds of different equities that are falling into this component. So I just want to highlight that because, yeah, that right when you said that, I had kind of like a mind blowing moment of that is a big deal. So appreciate you sharing that. I know we're hitting the top of the hour, so I just want to give you a chance maybe to send some people off with some final market concepts or market wisdom or anything of the sort, and then I can wrap us up and we can head out of here.
Yeah. So first, I'm ending. I'm throwing one last one, and I noticed say, which is a weekly chart of Citi, which
Wow.
is an interesting sort of pattern here. Now, I'll just say is we're in an interesting period of time here where we have essentially 2 to 3 weeks of kind of open space. And we have this idea maybe that next week we're going to have Jerome Powell talking at Jackson Hole. We don't even know that, but they've given this hawkish sense now. So I think that right now that's kind of what I'm watching. But I think when you take another step back and you think beyond that, we're in an environment where inflation really is coming down, and we might kind of see a couple of weeks and maybe a month or two of volatility here, but it could actually turn into something that, looking back 3, 4 years from now, could have been something of an opportunity for people looking long terms. And I would just say that when you look at the overall universe of what's happening here, there's some interesting things emerging with home builders emerging as an interesting area of strength. We have these AI and technology stocks that have kind of established themselves. And so we might have something of a kind of pullback here, and it could turn into something where people can, if they miss things, actually kind of come in. Because I look right now at inflation as having really kind of improved. And we might just have a period here that kind of gives us some opportunities.
The inflation aspect is such a uh, I think smart note to end our chat on because we all know inflation has been one of the most talked about things in our existing market. And if it is finally slowing down, and you talked about sort of that forward-looking, events calendar of that Jerome Powell is speaking soon. That is something we probably want to have. We probably want to have our finger on the pulse of because that even will change the way Powell approaches markets, which, as we know, could then change rates. So very, very interesting and important. And actually, before I do the wrap up, how about any other events on the calendar? So we got Jerome Powell in Jackson Hole. Anything else coming up that maybe some traders or investors should mark on their calendar? Isn't there? You were mentioning that tech event yesterday.
Well, we have the potential for Apple iPhone in the middle of September. I don't think it's been confirmed yet, but that's going to be something people start talking about when you get about a week or two ahead of it. So I think we want to kind of watch that because no one's going to want to really jump in right away, but people are going to suddenly remember in early September, oh yeah, there could be an iPhone soon, and something like Apple might have an opportunity coming out of that.
Perfect, perfect. We walked through the macro, the top-down approach. We did some review of technical indicators, looking back, and we ended on keeping your eye toward the future and events to come in the market. So, ladies and gentlemen, thank you for joining the TradingView show. You just had a great chat with TradeStation's global head of market strategy, David Russell. In addition, I think the best part about this show and meeting David is follow the TradeStation account on TradingView because you just met and heard from the man who is creating and publishing some of those awesome ideas and charts. So, you can leave comments, follow, interact with the post how you please. So, thanks so much for joining, David, and to all of our viewers, listeners. We hope you enjoyed this show, and we will see you on the next one.
Thanks, Stefan.
Of
Good to
course.
talk to you.
I'll see you, David.
Bye bye.